Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. It's really good to be back on the show this week. And Miles, I'm going to ask you the question that I'm getting asked dozens of times a day by clients, and that is gold going to continue climbing? Has silver stopped yet?
Yeah, gold's going to go to 350 loaves of bread. That's the price that gold's going to go to. With the inflation rate, a loaf of bread is going to go to some astronomical number.
Let's say $8.
That we can't calculate quite yet. So Rob was on the show last week and a couple weeks ago where we were talking about the Elliott wave impulse patterns that we could be seeing, where we had our A wave rise through the end of last year, beginning of this year. We had a slight B wave decline, and now we could be moving into a C wave impulse pattern up. Now, the big argument with the C wave is it has to exceed what the A wave did. So that puts us up around possibly 2350 by the time this move is done as the next potential high in gold, as a minimum for the next potential high in gold, as we're continuing this, what we think is going to be a multi-year bull market in gold. So what happens between now and 2350? And I think that's the question I know a lot of my clients are asking, and yours are as well, because we just had what feels like a significant rise in gold from around 1800 to very, very close to the all-time high we put in last year. In 2022. And we've come back down a little bit, about what, $40, $50. We've come back down thus far. So could we have seen, amidst this long-term C wave rise that we expect to see, could we be seeing a little short-term pullback here in gold and the other metals? I think is a good way to kind of lay out the question, if I'm not wrong.
No, I think that that's right. And since we know that gold and silver, for that matter, react to underlying fundamentals a lot of times, the question really has to be what underlying fundamentals are going to change that would create that type of a pause or a pullback. Sometimes it's merely sentiment. Sometimes It's an emotional reaction that has created an overshoot, or too much excitement in the market. Gold coming down to where we are right now, we're recording at 1,996. Okay, that's sort of a healthy pullback. Certainly not an interruption to a C wave climb per Elliott wave. But I'm with you. Yes, we could continue to run here, or we could have seen the top, because the question that's going to be answered as well is, have we put in our third top here? We put in one in 2020, right around just under 2,080. Again, last year, just under 2,080. It was actually a little lower than the 2020 high. And now if 2049-ish that we did last week ends up being the high, that's a third top here that doesn't quite exceed the previous two. So I'm a little concerned about that, but all that to be said, let's go with the run. Let's assume that fundamentals don't change. Let's go with the 2350 or so run. If we see that, then what does a breather look like? And you touched base on this here a few weeks ago, but it's worth readdressing.
So in the short term, if we were to see a pullback here in the next few weeks, which I think is pretty likely, I think you're looking, the A wave high back at the beginning of this year, so around 1960, maybe a little under. 1930s, your 50% line. 1902 is your 618 fib. And that actually lines up with a couple little price action positions that we had that I'll circle on the chart now, just so you can kind of see there are some pricing levels here where you could see us pull back to as entry points as we continue what we think might be a C wave rise. If that's the case, and getting to your bigger question, if we get up to 2350, well, what can happen then? And I think you kind of already answered it. I think it depends on how it gets there. If we're just looking at the extended macroeconomic concerns and problems that we're dealing with now, and we have a drawn-out process that takes us longer to get there, then you can assume it's going to feel like trading as normal. Things are just trading up and down as they do, and they're tending to trend upwards towards that pricing. On the flip side, and this tends to be what we've seen with gold, is gold does tend to be very reactionary to news. And one of my biggest arguments has always been news doesn't actually dictate the direction a market goes, but it has a pretty strong impact on how quickly or slowly it gets there. So you could see us move up to 2350 over the course of 2 years, or you could see us get there in 3 months.
Oh, that's such a great point, because this feels like that 2007 to 9 period of time. So you and I are kind of talking about just subjectively in terms of the energy in our market, the interest in our market, the central bank buying, all those sorts of things are kind of pointing to this buildup that are saying, hey, the gold price is going to continue to climb. Remember, from 2004 to 2011, gold went up 400%, okay, in that 7-year period of time. In the middle of that were a couple of pullback opportunities, like you were saying, opportunities to enter or buying the dip, if you will, including an almost 30% pullback at one point before it went and set that all-time high of 1,925 an ounce in 2011. So where are we in that cycle? Because this cycle does feel very similar for different reasons, right? A little bit of different underlying triggers that are taking us there. We've got a repeat sort of banking concerns, but it's not apparently housing yet.
Yeah, we'll see what the derivative market looks like these days when that jumps up out at us. So, yeah, we were talking about this before we started recording, and I completely agree with you. You said it feels like 2009 again. And I absolutely agree. I think the consensus, the way it feels around the office, the way it feels when we talk to distributors and other dealers and our clients, and the volume within the U.S. precious metals industry as a whole is stretched about as thin as the manpower can handle. It feels like 2009 again. But the scary thing for me is when I look at the charts, you mentioned we're now 3 times bumping up against that like just under 2100 mark, and we can't seem to get past it for some reason. When I look at the charts, I'm like, this doesn't feel like 2009 on the charts. This feels like 2007 on the charts.
Which makes a lot of sense.
And is very scary because it feels like the crash has already happened. And the fear has set in, the market is collapsing, and people who have never been involved in the precious metals market before are looking for any type of protective hedge they can get their fingers around. But when I look at the charts, those things haven't happened yet. The stock market's down 20%, but it's still bouncing. We haven't had a panicked crash in the equities market.
Absolutely.
We did not have, or at least thus far have not had, a major domino effect banking crisis kicked off by SVB. These things that feel like they're right on the cusp of occurring have not occurred yet. So my big concern is if we are 2009 busy in a 2007 market before the crash happens, what happens if the stock market loses another 20%?
Yeah, which in all reality should happen. Like, we will see a Dow to gold ratio of sub 10 to 1. That just happens in equity bear markets, where you take the value of the Dow, divide by the price of gold, and it gets below that 10 to 1. Well, that's got us pulling back another 20%. Let's say gold goes to 2,500. That's the Dow at 25,000. That's very reasonable to expect.
And that can happen in
cycle.
3 months.
Absolutely. So you give me chills by saying that, because you're actually very right. Remember, in 2007 and early 2008, in 2008, we went and hit $1,000 an ounce for the first time. Gold hit an all-time high in a calmer sea and in a predictive fashion a little bit.
Right.
Then you had Lehman Brothers and Bear Stearns fail. Then you had the fall crisis and the global ripple effects and the crash in housing and the credit markets. So you're right, Miles, we haven't even had the event yet.
No.
And we're already sitting at an all-time high. And that's why we don't care what the all-time high was. It also makes your charting difficult. But we went from 1,000 all-time high in 2008 to a pullback initially to almost a double, or it was more than a double at 1925. What if that happens here? We're talking 3,000 plus gold, and your charts are all getting reset.
Sure. And then Jim Sinclair was right 20 years ago when he said, well, gold's obviously going to 3,500.
That's right.
So the difference is gold was going to 3,500 when the central bank balance sheet was like $500 billion and interest rates were still down at like 2, and the U.S. national debt was like still under 10. So it was a completely different world back then. I think given the string of events over the last number of years, me included, I just think we're all raw nerve. It's COVID, it's Russia, it's China, Taiwan, it's what's going on in Venezuela right now and the starvation that's taking place in parts of Central and South America, new business dealings taking place, the war in Afghanistan. It's the string of events that has just chewed away at the nerves of the Western world. And the Eastern world is out there marching forward with trying to find brand new versions of what business as usual means. So here we are over in the West, and I think we're getting very, very reactionary to almost every little thing that happens. I don't know anybody that has an account with SVB. So I don't have any clients that had an account with Silicon Valley Bank. I know lots of people did, more companies than people did. But I don't know anybody that personally has an account with them, but I know millions of people were heavily emotionally affected by watching that happen because we talk to a lot of them. And the clients we don't talk to, we watched how much money was getting moved between banks over the month following that. I think everybody is sniffing the air. We're just waiting for whatever the crack in the dam ends up being. I think there's a lot of people just waiting for that to happen.
Well, I think a big part of the problem, too, is the great financial crisis is not that far in the past.
Right.
In some instances, we never have gotten out of it. So it's very recent memory, compounded with COVID and compounded with all the recent events that you stated. And that's why when people ask me and my clients are calling saying, what is gold going to do? I'm saying, how are the fundamentals going to change? You have geopolitics. You mentioned some of that drives gold higher. You have the debt. You have interest rate hikes. In the next Fed meeting in May, they're likely going to rate hike again. You've got unstable, unpredictable markets. Gold goes really well in that type of an environment. You have manic central bank buying. You have recession or negative economic numbers. You've got inflation. You've got a negative real rate of return. You have, the U.S. dollar and the target that it has on its back as a reserve currency status. You've got bond market instability, which I'll touch on a little bit later here. You've got money supply that continues to grow, Federal Reserve balance sheet, social unrest. We just saw these Chicago mobs starting to ramp back up again. You've got the banking concerns you just talked about. All of those are pointing to owning gold. So, okay, one or two of those might change course, but do all of them in the short period of time? I don't think so. And that's why I think there's a lot of wind in a big, big sail for gold.
Well, and it's been kind of fun for me, and I assume you're having the same experience as well, is for people who have experienced and been in assets like precious metals or land ownership, or have a portion of their assets set aside for the purpose of long-term preservation. We're getting a lot of calls, but my clients I'm working with, it's an addition call. It's, hey, there was another event, I'm already balanced this direction to begin with. I think I'm a little bit too heavy on the cash side. I'm going to move a little bit more cash into precious metals. So there's a definitive reactionary difference between somebody who is looking at this from that long-term perspective you're talking about, where it's about that long-term trend and just having a balanced portfolio that's going to protect you through the highs and lows as the market moves up and down. You want to have an investment position that's growing for you in an asset that should do well over a long period of time. Like, say, what our wealth management company does, where they're looking at companies based on, say, dividend production or hard asset production, things where the common stock price has less meaning than if you just go out and buy Amazon directly off the exchange. Or you have a precious metals position, which is going to act as a safety net. And then you have a liquidity position at a good bank. And we've done a whole lot of bank ratings for people over the last month or two, just to make sure that hopefully you're not in the next SVB. There's such a distinct difference that I'm seeing right now between people who have been watching this play out for a great number of years and people who are waiting for that kind of last crack in that dam, that last feather on the back of the horse to finally break its back, and are jumping in on news events. And I think that's the nice thing about working with the clients that we get to and the listeners that we get to is looking at it from a rational and reasonable standpoint that market cycles happen, and this is another market cycle.
That's right.
And if you position yourself in a way that makes sense regardless of market cycles, you're going to end up on the other side of it at least even.
We don't want fear. We want pragmatic, prudent approaches. And this is the type of environment where if you're doing your homework, you're listening, and you're really educating yourself, you're going to make wise decisions. And that's obviously naturally going to include a precious metals position in the portfolio. And I'm going to bring us back now to the other metals. We haven't talked about as much silver. We haven't talked about platinum and palladium. And those are acting a little bit differently. Today's a good example. Gold is down. Silver, platinum, and palladium are all up. Let's dig a little bit into those charts.
Yeah, I think that's the perfect segue because sure, there's the way you can build your whole portfolio out on a regular basis like we were just talking about. But the nice thing about doing that is when other people are running around just to get any type of position, if you're already accustomed to how you build out a precious metals portfolio and working with one of the advisors here at ICA, I can look at these charts and I can say, okay, it really does look like gold might have put in a top and we may be seeing a little short-term return here. But when I switch over to the silver chart, I look at this and I say, I still think silver has some room to run right now. And you and I both know that the gold to silver ratio, which did top out a couple years ago and has been working its way back down, is still back up, I think, where? In the low 80s right now?
We're actually at 78 today.
Okay, so we finally broke back below 80.
Yep. Gold going down, silver going up today. I mean, a few weeks ago, we were still at 91. Don't blink. Here we are at 78.
Right. And a while back, I think, didn't we get down to 60?
We got down to 62.
Okay. Yep. So we are starting to stair-step our way back down to maybe 45, maybe 40. Now, again, that's something that takes time. But we know a lot of our listeners, a lot of our clients had been buying silver a number of years ago when we saw we got to some of those ratios. And lo and behold, not only is the ratio going our direction, but there's some products out there where the buyback premium is significant, like Silver American Eagles.
Yep.
Right now.
Happening all over again, repeating the fall of 2022.
So I look at the silver chart here and I think to myself, okay, we just broke through a declining trend line. We had a declining trend line going all the way back to like May of 2021 that we finally broke above that. We got a decent chip above it, and then we came back down here over the last day or two. And like you just mentioned, silver's up today. We had a hard bounce off of that trend line, which also lines up with the high from end of last year, beginning of this year, like December, January high. I'm extrapolating out and stretching out some of where my retracement levels could line up with some pricing action. And I'm looking at this chart going, RSI doesn't tell me we're turning around. You extrapolate out those trend lines, I'm up at like 27.5 before just this short-term move is done on silver.
Which, interestingly, that goes back many months that you have said that before. So trusting your knowledge and your approach and all that, that's not coincidental, I don't think. That's almost a gap that has to be filled in a sense from that washout
that's a
that
good,
we had.
I like that gap. It does look like a gap that has to be filled. So I like the way silver looks right now. Now you got to buy the right thing. You got to get into the right product today.
Well, Silver American Eagles are already approaching $40 an ounce.
Right.
In my opinion, that's not the right thing. So that premium is up 10% in the last 3 weeks alone, just that product.
Right. And I'm seeing a similar story in platinum. You know, platinum had a long-term declining trend line, which goes back a number of years. We actually broke above it short-term back at the beginning of this year, came back down, but we're broken and pretty strong above that trend line now at this point, and we're back up to that January top. So I think platinum probably still has another $60, $70 to run on this move. And from a ratio trading standpoint, I think it would look very good and continue the trend. Now, we're not at the bottom yet, and I think we're a ways away from making those big gold to silver swaps. But it's nice to see we're taking the stair steps down. So if we see gold playing out here at a top or even turn down a little bit, while silver takes another couple dollar rise, while platinum goes up another $60, $70 up to around $11.60, I think that just adds way more fuel to the fire of the ratio trading strategy works if you allow it to do its thing over a period of time. And setting up your precious metals account in a way that protects you and occasionally brings in this ability to increase your position without costing you any more out-of-pocket money, I don't see how it's not a no-brainer.
Well, it's interesting because people don't look at gold as an investment. We don't even want our clients looking at it as an investment. But very few people realize that in the last 22 years, since 2000, gold is up 600% compared to the S&P 500 at 204%. I mean, think about that, how much it has outperformed the S&P 500. And yet people say buy and hold your S&P 500 positions over time. Well, gold's done much better, and that's a 23-year look. But looking at 50 years, gold's up 5,300% compared to S&P 500, 4,000%. Well, guess what? With the compounding out strategies, we outperform that spot price performance by another 150% in that period of time. So you get this exponential growth by, you're right, diversifying accordingly. And we're not close to a platinum palladium ratio trade either right now, but it's definitely headed in the right direction.
Right.
Palladium's down $1,000 an ounce and platinum's been climbing. You talk about a tightening ratio, it's going to start to get real fun when they get to parity with each other like we've seen so many times.
I always love the line, God doesn't paint in straight lines. If you in the audience can tell me what movie that's from, throw it in the comments. You'll never get it, but it's a great line.
Well, you stumped me.
So God doesn't paint in straight lines, and markets are just a representation of what X number of people are doing. What's the crowd interested in? So of course it's not going to be a straight line. This is our human biology multiplied by 7 billion. So we're going to have our trends as a species, as an investing species, but it's obviously not going to be in straight lines. And I think we're seeing the perfect example of that. Now, with that being said, you can't time the market perfectly. Obviously, if I could, I wouldn't bother going to work every day. I'd just sit at home and be a quadrillionaire. But what you can do is you can look for those trends. You can set up a long-term strategy, and then you can occasionally make incremental adjustments to it based on what it looks like that trend is going for right now. So for those guys out there that are sitting on a platinum position, it's doing what it should be doing. For those guys out there who have brought in the investment piece to their long-term gold portfolio by adding in things like 100-ounce silver bars, it is going the direction that it's supposed to be going. It's taking time to get there. But like you said, Tori, a second ago, I do these things just like you do, not because I think my precious metals position is a quote-unquote investment account, but because I just want to have more gold. And if I can have more gold tomorrow by owning silver today, yeah, I'm going to own a little bit of silver today.
Got to diversify. That's right. And I don't want to be owning U.S. dollars.
No.
We haven't even talked about the U.S. dollar index chart. We haven't talked about China. We've got China stimulating their economy to the tune of $2 trillion in the first quarter this year. I'm going to make a bold prediction, and I'm going to say that China is going to export their inflation to us because they can't possibly stimulate to that level without creating their own inflationary environment, which will necessarily push inflation our way because of the sheer magnitude of manufacturing, production, acquiring, that we have. The trade imbalance is necessarily going to impact us and going to add to our own inflation. But that doesn't help the U.S. dollar. And the U.S. dollar showed a lot of weakness last week. To me, breaking just below that trend line, I was anxious to see if it was going to hold at all.
Yeah, the US dollar has definitely planed out. The bounce was pretty weak back in March, way less than I wanted it to be. We didn't even get back up to the 200-day moving average, and we're right back down to the low from the beginning of the year. So, yeah, I don't see any strength for the dollar. The bond yields have come back up a little bit, but we're not back up to where they were in February, even though interest rates are higher.
Yeah, and speaking of the bonds, before you skip over that, the 3-month T-bill just hit 5.21%. That's the highest since January of 2001. And for perspective, it was 0.79% this time last year, from 0.79 to 5.21. And 2 years ago, it was at 0.02. That is not a stable bond market.
No. And good luck getting anything near that from your local bank CD. And then looking at the equities market, yay, the equities market had a bounce, but it still hasn't put in a higher high, at least not since we bounced back in December. So it's still trailing downwards as well. So I don't know, what else do you do? I don't know what else you do. Make sure that debt's locked in from a few years and don't refinance your mortgage. Not now. It's too late. I think we're getting back into the era where borrowing money is not the right course of action. You know, the era our parents told us about, but I haven't had the privilege of growing up in.
You made your riches, convert it to a store of value. That's what gold is. And sit and wait.
Yeah. And then we'll tell you when opportunities present themselves if you want to add to your position or swap stuff around to pick up free ounces. So now is the time for calm. Now is the time for logic and reason and expectation. And that's what we'll continue to recommend you do here at McIlvaney Precious Metals. So if you want to talk to one of your advisors here, you're welcome to give us a buzz. We can be reached at 800-525-9556. You can find more info on our website at McIlvaney.com. We're also on Twitter at ICA Gold or on Facebook at McIlvaney Financial. Thanks again for listening. We hope you have a great week, and we'll talk to you soon. Take care.